Hello and welcome back to On-Chain Reaction. I'm your host, James Bennett, and I'm the CEO of ByteTree. Okay, let's jump right into it. So we're going to start today by looking at volatility, which has been falling since late January. It's currently sitting around 80%, 30 days annualized volatility, as Bitcoin touches $60,000 and has begun now to retrace back towards 55,000 as of Tuesday, the 23rd of March. So we can see here, we've pointed this out before, that this bull run is actually seeing lower volatility than all of the previous peak cycles. That's not to say that we are in a peak, but if you look at the 700% price growth we've seen since March last year, then you could be forgiven for thinking that we're near getting closer to a top somewhere. So in the previous cycles, particularly in late 17 and then again what we saw mid 2020, Bitcoin's volatility was up towards 150, 170% in the previous sort of bull run. And this is indicative of a more mature market with slightly more rational investors and long-term allocators involved this time around. So overall, very high volatility compared to other commodities and assets. But for Bitcoin at this stage, it's actually looking pretty promising. Okay, so now diving into the on-chain activity. Well, first thing to recognize is the fees as a percentage of the total revenues have been easing as Bitcoin network activity has been easing as well. Remember, fees are essentially paid for block space. So higher fees means there's higher competition and higher demand for block space. And there was an uptrend that we've been revisiting on these Coinscrum on-chain reaction videos. Since January 2020, we can see that uptrend began. The gold line there indicating the fees as a percentage of revenues. And in the last sort of couple of months, we've had a sharp correction down from about 17% to about 12%. Now that 12% is still, if you look at the far side, right-hand side of the chart, is still a higher low than what we saw in sort of end of January, but it does appear to be easing. So this is something we're looking at very closely. Again, fees are indicative of network demand. Okay, so then going straight into total settlement value, so how much is being sent and received over the Bitcoin network. We've seen that on-chain volume pushed up to about $14.14 billion per day in late February and has currently sort of retraced to that $8 billion level. Again, on the right-hand side of the graph, you're looking at the black dotted line, and you can see how we've had a couple of lows tested at around $8 billion, and that's where we're sitting at the moment. Strongly follows price generally, since this is Bitcoin value transferred at the dollar rate. But when we see that divergence between price and on-chain activity, we know that on-chain activity is actually falling away whilst price is increasing. Again, indicative of a slower or a lower secondary market demand on Bitcoin. Okay, so that's what's happening on-chain in terms of the demand, but what about off-chain? So a big story at the moment is the fund flows in the US. The story is around Grayscale, which started trading at a discount. Grayscale then announced that they would invest or buy back $250 million worth of GBTC shares in order to try to return their product back to net asset value. There's the thing about the US funds is it's difficult to really get a flavour for changing sentiment outside of looking at the premium discount, because a lot of them are closed-ended funds, which means that Bitcoin can only go in. So Grayscale has about $40 billion of Bitcoin, and in fact they can't sell those at the moment based on their sort of mandate. So if people want to sell GBTC, then we move to a discount, which is what we've seen. But the Bitcoin won't leave the fund. It's a one-way ticket, that particular instrument. But in the European sector, we have better liquidity. Investors can put money in and then they can take money out again. So therefore you can see when investors are taking out their money, then the total Bitcoin that's invested in those funds is dropping. So European flows, because of the different products, right? We're looking at exchange traded products as opposed to closed-end investment funds in the US. These are more liquid instruments. So we can see here the trend has been very much positive since records began. So mid 15, I should say. At the time, it was mostly just the XBT product from CoinShares, and since then we've seen a lot of new entrants, including 21 Shares, Ham, VanEck, WisdomTree, and the likes. Still we're seeing positive inflows, particularly since sort of Q3, Q4 last year. We're looking at this closely. I think if European fund flows start to drop off, particularly if they start to go negative, you can see in sort of Jan 17 and December 17 in particular, and then early sort of March 20, which was that liquidity crunch event. You can see when fund flows dropped and the impact that they had on price. So that's definitely a metric to look at closely. Okay, so next up we're going to look at the miners side. So miners are selling less Bitcoin at the moment, with miners rolling inventory, which is a metric we developed at ByteTree to track miner sentiment, is trending back towards 100%. So when MRI is above 100%, it means for every new Bitcoin, it means they're selling more Bitcoin than what they're generating. So their net inventory is declining. When MRI is below 100%, it means they're mining more than they're selling. So their net inventory is increasing. We can see that miners typically sell heavily into strong market bid. So when the price is going up, they sell heavily, and we can see that particularly since the beginning of this year. I think we've touched on this before, but MRI peaked at 165%, so they're selling 65% more than they've been mining. How do they do that? They've been sitting on it in their inventory, but since we hit that peak price the first peak that we saw towards the end of February, they've really been holding back, waiting perhaps for a stronger price, waiting perhaps for another cycle. It's a bit too early to say exactly what their motives are here, but we can look at the historic trend from miners' inventories to get a better feel for what they might be indicating to us. So here we're looking at miner inventories over the last 8-9 years, and there's a very clear sort of high-level picture, which is that during bull markets, inventories get depleted heavily. So the rate of inventory decline is accelerated during those periods, and you can see highlighted in green in the sort of 13 to late 13 and then late 16 to late 17 cycles. The blue line there indicates the Bitcoin inventories, and in both cases, there's a real change in pace that they're offloading their inventories. And then as soon as they stop selling heavily, and you can see particularly in Jan 14 and then sort of Jan February 18, there's another change in pace. Inventories start building, and their price starts to weaken and fall, and we move into that bear market. So I'm not saying that that's where we are at the moment, but if we look at the next slide here, zooming in, we can see that miners have started to consolidate their positions since the beginning of March. So late December through January and February, we can see that really strong, steep sell-off. And then the blue line on the far bottom right of this chart, we can see has started to level off and taper. It indicates at the moment, miners are uncertain about the future. Can they get a better price a few months from now, or should they just be offloading their inventory at the moment? I think it's a little bit too early to call a top, but I would say that we're looking at these metrics very closely, in particular the fund flows and MRI on the ByteTree terminal. Okay, that's all for me for now. As always, if you have any questions, then do reach out at james@bytetree.com, and I'd be happy to chat with you about any of the metrics that we've seen today. That's all. Goodbye.